Impulse and correction, impulse and correction. This one is not correction. This one is not impulse. The same thing for here. Here is our starting point A. Here is B. Here is C. And here is D. So that is one thing you must understand here. Then we have another one which I was trying to explain, which is called the micro and the minor break of structure. So please take note of the minor and the micro break of structure. You see, this is AB, which is an impulsive move. But inside this impulsive move, there are micro one. There are the minor structure, which is this small one. This one, the minor one. If you go to chart, you will see it. All these are minor one. But the real impulsive move is from here to here. That is why a real correction in the market will take up to like 50% of the previous impulsive move. 50% of the previous impulsive move. That is the real correction. Sometimes you see a market will move like this one, you move again, this one, you move again, this one. All these minor correction, all these things are minor correction. But if a market move like this and go up, you see a real correction supposed to take 50% of the previous impulsive move. I don't know if you are understanding me. Are you understanding me at all?
Yes.
Because this one is a real move. That is one thing people don't understand about the market. This one is the real impulsive move. Then it's a correction. It's a correction, take 50% of the previous move. Then before you now move another impulse again and go up. Then if you want to make correction is supposed to enter here, 50% of here before you continue again. That is a real correction. That is a real impulsive move. So every impulsive and correction move, that is why if this market break this thing now, you see 50% here should supposed to be another block that cause the break of structure here for the market to rally up again. So that is how it is. The same thing for a bearish market. This is an impulse. This is a correction. 50% of this impulsive move, that is a real correction. Although we have minor one, minor impulse, minor correction, minor impulse, minor correction, minor impulse, minor correction, minor impulse, minor correction, plus minor correction. So that is why I lovely to say that if we go to higher time frame, we will see the micro structure, which is the big move in the market. And the micro structure and the big move in the market. These are the micro structure. It's a big move. The minor one are the smaller move, which you can see on a smaller time frame. Are you getting me? If you go to like D1 now, you can see a big move. But one candle in D1, if you come to one candle like this in D1, if you come to smaller time frame, it's a very big move. Is it not true? Are you guys following me at all? Hello? Hello? Hello?
Yes, we can hear you.
Okay. I just want your response so that I will understand that you are listening. So
Okay.
this is a bearish market. This is a major, this is a micro move, which is the big move in the market. This big move in the market, you can see it from H4 upward. This is the correction, and this is an impulse. So that is how it is. Then we have the other one, which is called shift in market structure or breaking market structure. Structural shift in the market. Structural shift in market talk about breaking market structure. This breaking market structure also have to do with when a market fail to make a higher high. You see, for example, this one is an impulse. This is a correction. This is an impulse. Here was our last high in the market, and here was our last low. You see, when the market came down again, it broke the last correction. This last correction that is broken, you see, a break of structure have occurred. The market have to go back and retake 50% of this break of structure to move down. That is a break of structure. Also, we talk about there's a break in market structure. That is a this one is a bearish market. This one is a bearish market. A shift in market, so show a market coming down from a downtrend, impulse correction. It made an impulse, broke this one. This is our last low, our last low. Then the market went up, break the last high, the previous high of the market, it broke it, the last correction. This correction was broken. Then it now came back to retake 50% of this impulsive move and rally up. That's a break in market structure. But a shift in market structure, we see a market coming down with an impulsive move. Impulsive move. It made a correction, it made an impulse again, it break the last correction, then came back, make a correction, come down again, made another correction. It was not able to break the last correction. The last correction, rather, it went up and broke the high. The market has shifted. That we call a shift in market structure. When the market make two corrections with the same low, when it now broke it now, this low have now become what? The support. Is it not true? Am I right?
Yes.
Femi, are you with us today? Hello, Femi.
Yes,
Are you hearing what we are saying?
yes,
Okay. So this is what we call a shift in market structure. The same thing for a market going up. You see a market made an impulse, it made a correction, it made another impulse again, it made a correction, it made a correction again. The market was not able to break the higher high. It now made an impulsive move downward and break the last low of the correction. Immediately you break the last low, here has become a resistance. So automatically there's a shift in market structure. Automatically, this market will come back again to 50% of this impulsive move to rally down again to do the major move. So today we're talking about market structure, about a break in market structure and shift in market structure. That is one thing. So this is a break in market structure. This is also a break in market structure. But this is also a shift in market structure. There's also a shift in market structure. The markets are shift because it make a double correction and broke the last high. Can you identify this one in the market? Hello.
hi.
I say, can you people identify this one in the market?
Yes.
Like, okay, before this meeting and like, what do you like, Femi? What did you understand today, Seth? Let me start from Femi. What did you understand? I don't know if you can understand something, Seth.
Okay, uh, we just finished about talking about the shift in market structure. That when we're talking about the bearish one, the bearish when the market, okay, sorry, the break in market structure, the first one, before shift in market structure. When
Okay.
the market make the first impulsive move correction, then when it make the second impulsive, it will break the previous high to create another higher high. Then before it will now come back and break the previous low. the previous lower low, then make another impulsive before it will now bring a big, the big move in the market. Then when we talk about the shift in market structure, the first impulsive move, then correction, then the second impulsive will break the the previous low. After that, it will make another correction. Then when this last correction is coming, it will not be able to get to the previous low. Then before we now have a big move, that is a impulsive move.
Okay. So if you see this one in the market, you can understand it, Abi.
Yes.
Okay, that is the next thing we are going to do. What about Tawa? Is it Tadewa? Tadewa? Why is not here with us? Ebuka? Ebuka, oh. Ebuka is not. What about Tadewa? Speaking at Tadewa. Tadiwa. Tadiwa speaking now.
Our mic is mute.
Yeah, Ebuka speaking now.
I did follow up, I understand. Based on, we are still talking about the structure now. I don't know if you say there's a probability at times if the market is trying to make a correction, it will make 50% of the impulse.
Good.
So that one really piqued my interest.
Okay, 50% of the impulse, Abi.
Yes.
That is where Fibonacci now came coming. Although I don't know whether if Femi understand that one too. That is where Fibonacci now coming because yes, you cannot use Fibonacci retracement. That is where a break in market structure where Fibonacci retracement works very, very well. When a market break a structure, the Fibonacci retracement is trying to tell you that, oh, maybe when a market now broke a structure like this, maybe this market now broke this last high now, and you put your Fibonacci here. When you rally it up like this, here should be 50% of Fibonacci for a retracement zone for you to take it up. When you know that market are broken structure, coming back for a correction. Once you reach this 50 zone, then you take it up. So that is how it is. Although our time is remaining 1 minute. I don't know if you have any question.
I will still join now. Are you tired?
This is 9:43, almost 10 o'clock. Okay. If you didn't expire, you join again now. If you expire, you join again. So that is what I'm saying. It's the same thing here.
So
too.
in this smart money concept, so this thing is still what do you call it, Fibonacci? Is this still used in the smart money concept? Or are you
Yes,
just making reference?
it is used, but it's not that in the sense that we use it to even though maybe some people are too fearful, I say they want to use it and confirm if that is really a retracement or a breaking or another block or something. You can also use this too.
So it can help one to indicate another block.
Yes, it can help one to indicate another block. It can also help one to Fibonacci retracement zone. Although when we go to the chat, you will see join when you finish. Join again with the link. Join again with the link.
Okay.
It will soon stop.